you move from the UK to Australia and you have still got assets back home, a rental property, savings, shares, maybe a pension, there's a very good chance you are paying thousands more in tax than you need to. Average price of getting this wrong is more than $10,000, sometimes even more than $50,000. I'm a tax accountant, and after working with hundreds of UK expats, the same costly mistakes come up every single time. In this video, I will walk you through the 3 most expensive mistakes, including one you can still fix on past returns. The moment you become an Australian tax resident, the ATO taxes you on your worldwide income, not just your Australian salary, everything. Your UK rental income, your UK bank interest, your UK share dividends, even your individual saving accounts is completely tax-free in UK, but it's fully taxable here. Let me give you numbers. Say you've got £10,000 in UK interest, HMRC takes 20%, which is £2,000, but now you are an Australian resident at a 45% marginal rate. The ATO wants approximately $8,550 on the same interest. There is a mechanism that prevents you from paying tax twice. It's called Foreign Income Tax Offset, the FITO, and it's built into Australian-UK double tax agreement. Australia has to give you credit for the tax you have already paid in the UK. So the £2,000 you've paid to HMRC gets offset against your Australian liability and you only pay the difference. But here is what I see constantly. People don't claim it, they declare the UK income, they pay Australian tax on it, and they never apply the offset. The result is effective tax rate of 65% on that income. UK tax plus Australian tax stacked on top of each other. On £10,000, that's the difference between you paying roughly £4,500 in total or paying £6,500. Multiply that across a rental property, a saving account, a share portfolio, and you can see how this hits 5-figure fast. Everything I've just covered assumed you are a permanent resident or citizen, but a lot of UK expats aren't. They are on a skilled worker visa that changes everything. Under subdivision 768-R, if you are a temporary resident, meaning you are a tax resident but you do not hold a permanent residency, you are exempt from Australian tax on most foreign sourced income. UK rent, exempt. UK interest, exempt. UK share gains, exempt. Here is what it looks like when it goes wrong. A client came to us earning 200,000 in Australian dollars in Sydney and £20,000 a year from the UK rental property. They had been declaring the UK rent on Australian tax returns and paying 45% on it, on top of 20% they were already paying in the UK. They were on a 482 visa the entire time. The UK rental income should never have appeared on their Australian return. The problem is that this distinction does not come up in standard domestic tax work. Most accountants see Australian resident on the tax return and process it accordingly because of the vast majority of their clients. That's correct. But for UK expats on a temporary visa, that's a second layer. Whether you qualify as a temporary resident under section 995-1 changes your entire foreign income position. And if nobody checks, you pay tax you were never supposed to owe. We amended the client's return for the previous 2 years. The refund, including interest, the ATO paid on overpaid tax was significant. The fix took weeks, mistake had been running for years. If you are on a temporary visa and you are declaring UK income on your Australian return, get this checked before you lodge again. If you're finding this useful, subscribe. I break down Australian tax strategies like this, and most of what I cover is stuff you probably didn't know. So, this is the most expensive mistake I see and the hardest to fix after the fact. When you become an Australian permanent and tax resident, something happens to your foreign assets that almost nobody knows about. Under section 855-45, the ATO considers that you acquired your overseas assets such as your UK property, shares, investment at their market value on the day your residency changes, rather than the price you originally paid. This means the value is based on what those assets were worth when you arrived. The reason is simple. Australia shouldn't tax you on the gains that happened before you were an Australian taxpayer. You only owe CGT on the growth after you've arrived as a permanent resident. The problem, to use the uplift, you need a formal valuation of those assets dated to your arrival. Almost nobody gets one. Here is what happens when you don't. You bought a house in the UK for £200,000 in 2010. You moved to Australia in 2020. By then, the house was worth £350,000. You sell it in 2025 for £400,000. With the valuation on arrival, the taxable capital gain is £50,000. 5 years of growth without the valuation. The ATO defaults to your original purchase price. Now, your gain is £200,000, 4 times the tax on the growth that happened entirely when you were a UK resident, years before you set foot in Australia. On a property, this mistake alone can cost you $50,000 or more, and once the sale settles, without the valuation on file, it's extremely difficult to retrospectively establish what the property was worth when you arrived. Here is what makes this even more worse. All Australian tax calculations have to be done in Australian dollars. That means there is a currency layer sitting underneath every UK asset you own. Say you bought the house for £200,000 when the pound was worth $2.50. Your cost base is $500,000 in Australian dollars. You sell for $200,000, the same price in pounds, but now the pound is worth $1.80. Sale proceeds in Australian dollars 360k. In the UK, zero profit. In Australia, $140,000 of capital loss. Flip the exchange rate the other way around and you could have a massive Australian capital gain even though UK price didn't move at all. Most expats don't account for this and it rarely comes up in standard tax preparation because Section 960-50 of the tax law is a specialist territory. The currency layer can create gains or losses that have nothing to do with actual performance of an asset, and if it is not factored in, your tax position is wrong. Here is the part I need you to remember. Your Australian tax position as a UK expat comes down to 3 things. When you become a resident, what visa you were on, and whether you documented the value of your asset on the day 1. Get those 3 things right and the savings are real, between $5,000 and $50,000 in the first 3 years, depending on your asset base, of course. Get them wrong and you keep bleeding money every year without knowing it. If you have already lodged incorrectly, the amendment window under Section 170, it's 2 years for simple affairs and 4 years for complex ones. That window is open right now, but it won't stay open forever. If you think this might be you, the first step is a residency and visa review. We look at when you become a resident, whether you qualify as a temporary resident, what you hold in UK, and whether you have the right valuation in place. That's what a first call with our team looks like. The link is in the description. Book the call before you lodge your next return.